which is real estate, which represents on its own. We move on to another asset class, which is private credit. One of the few asset classes which have, from a strategic point of view, grown year on year in 2022 as well, I think about 5%. And this panel will delve into the nuances of why it is acting as a solutions gap, the incremental risk that private credit could take in terms of fund managers taking that risk, and banks or NBFCs in India cannot. So this solution gap is something that is being filled by private credit in India, and is an asset class which is showing a lot of interest. So I would like to, for a discussion on this, invite the panelists now on stage. We have joining us Kanchan Jain, CEO, Bearings Private Equity Asia Credit. Kanchan, can we have you on stage? We have Naveen Samtani, MD, Special Situations, Edelweiss Alternatives Asset Advisors. We have Prasanna M, Chief Sales Officer, Vivriti Asset Management. Prasanna. Thank you. We have Sabita Prakash, Managing Director, Asia Pacific, ADM Capital. Sabita, yeah. Joining us, we have Dinkar Venkat Subramaniam, Partner, Turnaround and Restructuring Strategy, EY. And to moderate the session, I would like to call upon stage Sridhar Nagarajan, Regional Managing Director, IKEQ. Thank you. Over to you, Sridhar.
Thank you. Thank you. Sorry. Okay. Surely the stars are aligned, and it's almost in the middle of the second day, and as I've been sitting and listening to all the eminent speakers, there's such a consensus, such a buoyancy of what's going to happen to India, not just the next decade. People are stretching it up to 100 years of independence. One thing is very clear is I don't think India has a demand problem, with 2/3 of its demand coming from its own requirements. So that puts most of the growth requirements coming from supply side. And private equity has done a wonderful job in supporting that type of supply side capital allocation to our industry. So this panel here is about what private credit can do to augment what private equity has been doing in terms of significantly ramping up the supply side and unlocking the true potential of India. So with that, and uniquely, I think I'm very happy that of all the proceedings we have, today's panel is the only one which actually focuses on the private credit side of it, and I'm really happy to be here moderating such an eminent set of panelists. To set the context, so I'm going to go to Dinkar first, as we call him as a guru amongst us. Actually, Dinkar, we all know that private credit globally has actually really grown post the financial crisis. It's around $1 trillion assets segment, which comprises approximately around 12% of the entire private capital. What do you see as the trends for private credit when it comes to the Indian market, as we have seen, as we are getting into the next 5 years, please?
Thank you, Sridhar. Morning, afternoon, everyone, and to IBCA as well for having me here. That you put me under pressure straight up, Sridhar, but I'll try and do justice to the eminent panel right here with me. So, rightly, I mean, the globally private credit has been the fastest growing asset class within the private capital group, 1.21 trillion as of October 2021, and as per Prekin research, it is to go to $2.69 trillion by end of 2026, which will also be the fastest growing in terms of that class. Largely, it was direct lending and distressed 60% or so. Geographically, 60% in the US, 30% in Europe, or 60% in North America, 30% in Europe, and rest of it was 10% or so. It was largely global financial crisis led when banks pulled out of riskier businesses and the mid-market businesses. That's where private credit stepped in and in the last 10 years, that's been the thrust that they have got to this growth. Flexible capital, obviously, which the borrowers wanted, while the lenders wanted higher risk-adjusted returns and a reliable source of income. And why, if I go back to why North America and Europe, apart from the fact that maybe the largest economies and the stress was also the most in post-crisis, but also because they had a very strong creditor-friendly environment there in terms of enforcement rights for creditors and both contractually and on default, probably the best in class, which enabled or gave the confidence, as Nipun also said in the previous panel, gave the confidence for them to put that credit out and meet that solution capital that was needed. Also, there was a very strong trading debt trading market available, which enabled value discovery to happen and deals to happen much faster at the value which both sides could meet up. And also, a stable currency environment is another pre-requirement apart from the whole regulatory consistency and growth that comes. So that enabled private credit to grow at that pace globally. Coming to India, corporate debt is still 17% of GDP in India, as compared to 123% in the US. That's the kind of delta. I mean, if you go back to 2000s, largely bank-led, our credit growth percentages in India of scheduled commercial banks was probably the best in the world in that time frame. As a result, 2010s, there was a huge buildup of NPAs, and in that time frame, the growth was still happening probably in the first half of 2010s, and that gap was being fulfilled by the NBFCs at that stage. They were coming in and pitching in for the gap or the solution that was there in the market, solution funding that was there. But post the NPAs were flushed out, and the NBFC liquidity crisis that happened late 2010s, there has been a gap in the funding. There has been a need for fund, but not much capital available for businesses which are not blue chips or where the obvious lending where the banks were doing were not there. So that's where there was a risk aversion from the banking side because of the NPA and the bank balance sheet crisis. The NBFC bust happened after the boom. But these are the supply side constraints. But on the other side, as we heard as well, there was the insolvency and bankruptcy code that happened as a big change and gave creditors the hope and the strength that enforcement could be much better if they could put money to work in terms of in credit in India. And the associated legal framework around that, stress resolution. So the IBC forced earlier stress resolution by the borrowers and by the lenders. The other RERA, as an example, as a law, was enforced. Generally, the regulatory environment was becoming much better in terms of enforcement for credit, which helped the mindset as well, and the stability in the currency as well. So all of these, coupled with the 5 trillion growth vision or the economic growth trajectory that we're talking about, I would say that's the structural opportunity for private credit for us in India, which is where in the last few years we've seen, and going forward we would see. Purely in terms of numbers, we thought in our report end of 2021, private credit will be about $13 billion in 2022 in India, and going up on an annual basis to maybe about 30 billion or so by 2030. But we ended up at about $6 billion in 2022. This is excluding venture debt, this is excluding offshore debt, and excluding money given to financial service providers. If you add that, then probably it's a much larger number. That's the number that has been put to work purely in terms of private credit. Where has this money gone to? Again, I would split that into what I call as performing credit, where the net IRRs are somewhere in the 12 to 18% or so, where when people put in the money, they think it is performing credit. And when the other side is the high yield or the special situations money, which go upwards, late teens, 18% to mid-20s and onwards. I know we had an interesting debate just before this, but a lot of the money that went in the last few years or so in private credit has gone in, I would say, in the high yield special situation side to to, a large chunk of it has gone there to bail out companies which were in stress, to buy out companies in NCLT, and for other special situations that have come in there. They've also gone into CapEx financing, largely real estate, but also infrastructure, renewables, where money being put in to complete those projects and get them working so that the cash flows can come in. But our recent survey also showed that apart from CapEx financing, apart from high yield and special situations, a bridge to IPO is also a big potential as we see going forward. So it's not, private credit is, we've just seen the tip of the iceberg. I think it's going to grow much, much larger. And as we see this moving, and come back later. Back to you, Sridhar.
Thank you, Dinkar. That's a comprehensive coverage on the evolution. Just to complement that, can I quickly come to Prasanna and ask you to give a scope and size of the industry before I move on to the others?
Thanks for the question. So the alternate industry that we represent here, it's currently about $100 billion. Roughly 10% of that comes into fixed income. And within that, so that's an industry size in INR, it's about 7 lakh crore, 70,000 crores is in fixed income. Within that, we have roughly about 30%, about 20,000 crore into performing credits. That's a size that we are looking at. But we believe that this space can grow exponentially.
No, thanks, Prasanna. That places the audience where what we are talking about. Moving to Kanchan, for you to add in terms of what are the funding gaps that private credit is really trying to attempts to cover, particularly in the Indian scenario?
So I think maybe I'll share a slightly different perspective here, and I think a lot of the narrative over the last few years has been there is inefficiency in the banking system in terms of flow of credit, and that's what gives rise to this big private debt opportunity. And I think we've probably very completely moved away from that. In just our learning from other markets where there is sufficient leverage in the system, banks are well penetrated, private credit is more than 50% of the credit that the industry uses, right? So it's a mainstream asset class, and we have exactly the same opportunities in India. If you look at, and the reasons why this has happened is if you look at all of the banks, even in India, our largest banks are 100 billion plus in terms of asset size, right? At that size, and the fact that you're fundamentally intimidating depositor money, I think the whole framework is that of a more centrally controlled risk framework, a more predictable templated risk framework, whereas credit is becoming more and more distributed in the way it gets disbursed. Right, which basically just means that banks are exiting out of the non-standard end users. And the reason to clarify this is that often the narrative is, oh, if you're making that return, or if they can't go to the bank, this must be some dodgy credit, or this must be very high on the risk curve, which is not the case. Right? Private credit is all the way from 6% to 20%. So there are a whole lot of end users, which may be because it's an asset-light sector, it's an asset-light end use. More and more dynamic corporates are looking to grow through various means other than just increasing the capacity. And a lot of those end users are not that easy to fund through your existing bank relationships. And that's exactly where all of private credit is coming in. Now, you can start with performing credit growth capital, which even in a market like US is more than 50% of the, of the pie. Acquisition capital, specialty capital, distressed capital, mezzanine capital. So there is an entire range of end users, which in some ways, and there is a very valid and mainstream role that banks will continue to play. But I think alongside that, there is a more dynamic, bespoke, structured requirement that private credit funds play. And that entire gamut of end users is the potential for how big the private credit industry or the gap that private credit industry can fill.
Thank you, Kanchan. Actually, as an ex-banker, I cannot agree more. I think there is a huge demand for private credit space to operate for India's own good. Moving to Sabita, just taking on from there, what are the capital solutions which you can sort of take us through in terms of private credit? And more importantly, because we are here in a private equity type of a forum, how can there be a confluence of private credit and private, if you can just take us through, please?
Yeah. before I proceed on that question, I'd just like to supplement Kanchan's question, because we speak the same language in a way, which is that there is a missing middle, I feel, which is that SMEs, smaller companies, are accounting for as much as 50% of the economy. And as there is consolidation, whether in the banking sector, whether in the asset management sector, or even in alternative sector, the average ticket size of individual funders starts becoming higher and higher. And so these smaller companies are left behind on the wayside. While they're contributing to growth in the economy, they're left behind on the wayside because they're not able to find funding in order to achieve that growth. So leading from that point, I would like to also say that we people in the alternative sector, in the private sector, can collaborate very effectively, because there is space for all. In Asia and in India particularly, we are blessed with the underlying growth, which my esteemed fellow panelists have talked about at length, so I'll not go into that. But I suppose the kind of financing that each of us can provide is just slightly different. In fact, even across this panel, if we look at each one of us, I'm sure if you talk to each one of us, we are financing slightly different aspects. Like for instance, the panel before us talked about real estate. At the moment anyway, at ADM Capital in India, we don't have a single real estate transaction in our books. But on the other hand, there's something like digital disruption, which is huge in India. Who is financing that? Of course, you'd say the VC and the PEs, and many people in the audience must be doing that. But at some stage, there comes a time when companies have become profitable. They've not yet got into the big league where they need 100 million of capital. But at the same time, they've got an assured market at their doorstep. That is where an entity like private credit strategies start becoming very effective, because we have end-use market. We, at the same time, don't have the traditional funding to play. At the same time, the track records are not really established, so there are many fund managers or even banks who may not be willing to play. So from that perspective, collaboration with private equity, venture capital, and venture credit is a wonderful thing, because private credit can provide an exit to venture capital, venture credit, can also provide leveraging strategies for private equity as well as venture capital as companies grow larger. And so we can collaborate on that front. And then, of course, I know Naveen is sitting over here. He will talk about the stressed side of things. So there's also another aspect where, you know, whether you look at a company as guilty until proven innocent or innocent until proven guilty starts changing the dynamics. So private credit is so flexible that we can talk about funding growth capital when companies don't have track records, as well as looking to help companies restructure where they've fallen a little bit on the wayside and they need to be helped back onto track. So I think not only between various private credit players, but we feel that we can collaborate very effectively with other sources of private capital. And that's why we, for instance, make a lot of our connects with other PE and VC and venture credit, from where we get a lot of deals and we give a lot of deals.
Wonderful. Thank you. It surely looks like the percentage of private credit, if that type of collaboration happens, is only going to go up. Why don't I straight away then move to Naveen, where we cannot talk about private credit without how those various structured solutions and distressed assets are being done. And also, Naveen, can you also cover a couple of the themes which has really helped bring private credit to the forefront? Even in the previous panel, they did mention about the bankruptcy code and other things. Please.
Thank you. Thanks, Sridhar. So, I mean, from whatever has been covered, there are clearly 2-3 drivers behind why there is a big regulatory cushion, right, in private credit and how we underwrite deals. Of course, Dinkar spoke about, you know, the whole IBC sort of framework. The legislative intent currently is around 2 things broadly, which is inviting more capital here, right? So one is to deepen the market in terms of participation of different kind of investors, to create a vibrant secondary market, at least in special situations. The other drive is towards giving more bite to IBC. Right? Now, if you look at the former, there are legislative changes, where you're going to have potentially a securitization framework for trading in NPLs, right? So there is a securitization, umbrella framework for standard assets, for example, for performing assets in India, which has always been there. There's some coming of age around that, where there's a discussion paper which has been floated recently, and hopefully will be, notified into law, where there will be a securitization framework for trading in NPLs. As far as adding more bite to IBC is concerned, and IBC itself, frankly, is a topic which can warrant a panel discussion, right? I'm sure all of us have our experiences around that. But I think the deliverance of IBC is directionally going in the right way, right? And that's giving, obviously, a lot of comfort for providers of private credit. We do have a sweeping lot of changes which potentially will get passed in the budget session. Without getting into the specifics of what we expect to change in the law, but broadly the amendments are going to be in 3 buckets, right? So one is going to be setting the record clear on certain judgments, actually, which have come out recently in the special situation space, which have caused a bit of a stir, right? So for the ones aware in the audience of Vidarbha paper and Rainbow, essentially concepts which were not enshrined in the IBC seem to have just come out in these judgments. For example, the whole idea of something called a solvency test is uttered nowhere in the IBC, in the law. But that as a concept seems to have been upheld in a recent judgment. So one set of changes, I think, will set the record clear on some of these judgments. There are some set of changes which will speeden up the whole purpose behind IBC. Now, whether it is something called the pre-pack version of IBC, which is, for want of a better word, a Tatkal IBC option for companies. So there are some which will go in the direction of just truncating the amount of time IBC takes. I think in the third category, you will have certain fundamental changes, right? Which will give more clarity, which will codify a lot more. One fundamental change, which I think we'll all look forward to seeing in terms of how it plays out. There was a lot of discretion. There is currently a lot of discretion with the Committee of Creditors under the law. And this goes back actually to a root principle that there is a certain primacy of the Committee of Creditors, and therefore commercial wisdom of the COC or the committee has been upheld. What you're seeing now potentially in some of these amendments that are coming in is some rationalization of that discretion, right? And with more things getting codified than leaving it to the discretion of the committee. And one such area is going to be, for example, who gets what out of the overall pie that comes into an IBC resolution, right? Which currently resides within the commercial wisdom of the COC, and that is going to get codified. Again, the legislative intent here is it will cut out unwanted litigation, but I think it will throw open a lot more debate within the Committee of Creditors. And I think how IBC gets used as a tool by various kinds of creditors in terms of their incentives and disincentives will change basis this aspect alone.
Thank you. Indeed, path-breaking legislation like IBC needs to be continuously improved upon. Thank you, it's covered. Actually, Dinkar, do you want to quickly add on this? I know EY is a policy-making influencer, please.
No, I mean, this is obviously very close to my heart as well. So from an IBC I think not just on the distressed or stress side, but I think everybody on this side, on the panel here, wants IBC to be strong, even if it's not used, because that enhances the enforcement rights that a creditor can have. That's one of the big change. That's what has happened is that Insolvency and Bankruptcy Code became the primary resolution tool which was available to lenders, and because of that, everybody was ignoring everything else and pushing everything into the Insolvency Bankruptcy Code, which kind of choked the entire judicial bandwidth and the system. I think the providing, I like the Tatkal option that you mentioned, providing a menu of options to the borrower and to the lender to resolve stress before it goes down further really helps the confidence that people will get, along with making sure that IBC works as it is intended to. And that's the big intent to make sure that this happens.
Thank you. That's comprehensively covered. There's one area which possibly we thought we should bring to light, and Prasanna, if you can throw light on it, which is we were discussing and you mentioned about there is a huge difference in terms of how valuation should be done from a private credit with respect to a private equity. We want to touch upon that, and then we will come to one particular question I want to ask all of you, please.
Yeah, thanks for asking this. Performing credits are fairly easy to value. So we do an accrual basis, and whatever, because they are performing credits, obviously by the definition, the underlying portfolio companies also pay us. So pay us quarterly coupons or semi-annual coupons, and we return it back to investors. So one, performing credits these days have started, the funds are rated, so you as an investor can clearly know that there is a direct bond available at a AA plus rating versus a fund that is available at a AA plus rating. Second, there is coupons that are coming in every quarter or semi-annually, and if there is no deterioration in the underlying credit quality, so there is a very fair valuation that you do. This accrual NAV helps investors understand, while regulatorily we are also supposed to provide third-party valuation, okay, but that's only twice a year. Here, most performing credit funds have gone on to a daily NAV model. Yeah. Valuations have become very, very simple.
Okay, that's good, because transparency is always a good building block eventually if you want to take it to the next level. Moving on, I want to, of course, this is all about LPs and GPs meet here. I want to ask Kanchan, how do you actually see private credit from the perspective of a GP and an LP?
I think from the perspective of GPs, it's, as we talked about, that's become a mainstream asset class. I think what's become interesting, what started off as, banks consolidating GFC-led growth. I think the second thing was, we were sitting on a zero sort of interest rate environment for a long time, and you had vast sums of money in pension funds and endowments and insurance companies looking for yield, right? That naturally made it to private credit. I think what has happened over the years, it has also proven to be a resilient asset class, generally across the board, globally, as well as, our sort of experience in India has not been any different. So I think you're able to deploy vast sums of money, so it's massively scalable. It gives you a significant amount of illiquidity premiums. In a market like India, you have the potential to earn high teens returns out of performing credit, right? Out of secured debt. There are also possibilities to earn an additional upside linked return linked to the performance of the business. So I think all of these make this, sort of a pretty interesting thing for GP. I also feel, I think in the Indian context, this is a great way to tap into the growth that's available across sectors in India. And just touching upon, we talked about SME. Mid-market, I think in India is a super interesting sector, right? At the top, fine, mid-market contributes about 40% to sector output. But I think when you drill it down on a sector-by-sector basis, 3 out of 4 sectors, the mid-market sector, the classic definition of $50 million to $1 billion in revenues, actually is a significant contributor of that sector output. You break it down further and you look at the top quintile or top quartile of companies within that sector, they're accounting for half of that sector output. So you have a whole lot of these companies that are actually, they're not small, they're not unbanked. And I say this often to a lot of the international LPs, that when you think of a $150 million company in India that's been around for 25 years, right? 1,200 crores, 1,500 crores of top line. I think when you think of it in dollar terms, you underestimate the market presence of the company. It's a business that runs well, that's a market leader potentially in its geography, in its product segment, and in some ways is best placed to grow from here, given all the work that's happening, right, in terms of reforms and growth. So that then becomes a great sector for LPs to tap into via private credit and benefit from the growth these companies are having. I think from an LP perspective, it's a great opportunity. You just scratched the surface right now. I think it's a great asset class that's completely sort of worth putting resources behind and, and developing the business from here.
Thank you. Anyone wants to augment that, their views? Sabita?
Maybe I can talk about it from the ex-India perspective for a second. Just because India has so much advantage on this front, which is that even a country like China, which we all know is one of the largest economies in Asia that's contributing to opportunities for all of us, has a much lower diversity in terms of opportunities for private credit participants. Whereas you look at, well, in the last few years, I'm not talking about the COVID years, but in the previous few years, it's typically cyclical. Sometimes property is in fashion, sometimes it's technology, sometimes it's retail and consumer, depending on what the government at that time is encouraging. And so from an LP perspective, it ends up becoming a little more concentrated, if you will, in terms of a portfolio construction perspective. You look at something like India, for instance, there's always a diversity. There is depth, as Kanchan says. The mid-sized companies are in so many different sectors, contributing, whether it's in manufacturing, services, property, what have you. And India has the benefit of having its own demand that has to be met. And therefore, from an LP perspective, investing in India is definitely very positive for GPs as well. Yes, India, for us, for instance, India has gone through cycles, so I'm not pretending to say that India is always positive. Sometimes we've benefited, sometimes it's been a bit challenging. And therefore, having a diversity perspective across the region does help for us. But India, I think, at the moment, is definitely a diversity play that everyone should look at.
Thank you. Thanks, Vita. I know we are coming to the end. Any new topic like this, our upcoming topic, we should always cover the downside and the risks. So do you all want to just give a quick coverage of what are the challenges and risks, a minute each? Sabita, you can start.
Yes, because I was so positive on India, let me also talk about where I really have to try very hard, particularly compared to many investors in India. We are still investing from outside with a different license. So therefore, one of the biggest issues in investing, private credit investing in India, and in fact any kind of investing in India for foreign investors, is that of regulation. Of course, it's changing positively, and therefore we are very appreciative. But if there is room for all, which I firmly believe is so, why not encourage foreign capital a little more assertively or aggressively? And so we are very hopeful that regulations can change to make foreign capital funding a little more amenable in India. So that's one. And the other is that because we have investors who look for dollar returns, the foreign currency component starts becoming a big deal. And I say this because it's not too many countries in Asia that have such an extent of problem as we do have in India. So over a period of time, as the currency settles and as we get into our groove, I'm very hopeful that this issue will disappear, but these are just two. This is two. And the third one I'd say is, I think what Dinkar referred to in the beginning about having secondary markets for exit. I think that's the reason IVCA type seminars are so useful, because our networking is what is contributing to all of us to exit and enter new investments. There is no secondary market that the public markets have the benefit of. To the extent that can be developed in some shape or form, I think it would be good for all of us in this room.
Thanks, Abhita. Naveen, you want to add?
Yeah, so aside from regulatory access, where directionally again, things have been moving there, I think for most private credit platforms at a very practical level, they're dealing with borrower situations where you will have holdco, opco structures and multiplicity of lenders. So to be able to convert an idea in terms of a solution, to translate that into a deal, which gives a composite solution to the borrower. I think the multiplicity of lenders where you have banks, NBFCs, and again you'll have public sector banks and private sector banks, each having their own considerations, balance sheet management considerations, time horizon considerations. So I think aligning and convergence of all these considerations becomes a big factor in the gestation period of all these deals. Where some of them can just remain in suspended animation because of multiplicity of lenders and therefore considerations.
Thank you. We have 2-3 minutes. Maybe I'll ask the audience for one question. Does anyone have a question please?
Good morning, and I'm in a similar line of business, not from an institutional side, but more in the private sector. We're doing the largest project, the Delhi One Four Seasons, which, as you're aware, went into NCLAT. We were the exclusive mandate, non-compete, non-terminatable holder. We raised more than 1,100 crores for that project. We signed on the largest luxury retailer, Genesis, Prada, Bottega, Louis Vuitton, which no one, I can confidently say, has been able to do on one platform. DLF also, it took them a little bit of time, but yet they were not able to get Prada. How important is the execution, which is where I feel, because now what we're doing is we're funding or we're putting in the bid for the NCLAT project, because we feel that just funding a project is not enough if the execution is not really taken care of, especially in the multi-land use projects like the retail, the leasing, because even then the developer is going to go to the assured return. 5 major players in retail, which all of you are aware of, Reliance, Madura, Kumaramangalam Birla, nobody's going to sign on assured return shopping malls. That's more than 36,000 crores going down the drain of SBI in Noida NCR itself, where they've already, I think, written off 9,000 crores.
Okay, fair enough. Of course, it is not restricted to private credit, but do any of the panelists want to address it? I think she's asking more about execution, which is a very common theme.
Yeah, I mean,
Please,
I think, partly, that is the key. If you ask me, that is the key. In fact, when we take a funding decision, it is not just looking at, how the project is structured or who are the funders are, is there financial closure or not, but the biggest call you're making or the biggest decision you're making is whether this execution is going to go as per track, who are the people behind the execution, who's going to, do the offtake. So I think all of that is a part of the entire due diligence you would do on any project before you do funding. So for us, that funding closure doesn't happen without a full analysis of, the execution and offtake risks, and not just on this project, but I would say, any project.
And I'd add to that by saying that private credit or credit as such, fixed income, we're all born pessimistic, I think. That makes us very good investors, because what we do when we look at deals is identify the downside scenario. What is the break-even scenario? What is the downside scenario? Which is where is money still protected? Can the investment still go ahead? And being so downside focused, I think, helps, because we need people with upside focus to help companies grow, and we need people with downside focus to help companies stay on track and and remain honest and remain committed. So I think that's the other very big reason why equity and credit need to work together to make this happen. And from an execution perspective, obviously one needs to figure it out, but having board memberships, which we often do in the private credit side of things, together with our private equity cohorts, does allow us to ensure that there is frequent reporting and following governance processes to maybe not ensure that the business is doing well. After all, the promoters know their businesses much more than us. But at least when asking the question, everyone tries to be honest and everyone tries to buck up if at heart they want to do a good job. So that also helps.
Thank you. Thank you so much, Sabita. And thank you, panelists. Unfortunately, we are run out of time. And it's a fascinating topic we can continue to discuss. But really appreciate you all coming and sharing that with all of us here. Thank you so much.
Thank you, Sridhar. Thank you. Thanks, everyone.